And that is the market. Once again, front and center, but it's a good day today, or at least it's shaping up to be after a wild day of trading on Wall Street. Yesterday, the Dow staging a late comeback, swinging more than 850 points from high to low. And that's been what we've seen the past 6 sessions. We've seen 1% plus moves in both directions for the Dow Jones Industrial Average. Let's talk about it and bring in the founder, CEO, and chief investment strategist at Mainstay Capital Management, David Kudla. David, good morning.
Good morning, Lauren.
What do you make of the volatility?
Well, it has been quite extreme in the past week, in the past month, and really the past quarter. It is what we expect now going into 2019. We had it very nice in 2017, the first part of 2018, but we've seen extreme volatility pick up through all of this year, and this is what we need to expect more of. And a lot of it is because there's this confusion, or maybe a seeking of what is the economic outlook for next year. We had as little as a month and a half ago people thinking that the Federal Reserve might hike 4 or 5, even 5 times next year. That went down to maybe a couple of times. Now the Fed futures, the prediction of how much the Fed will raise next year, is showing us that they wouldn't raise at all. But the Fed dot plot, their own forecast, shows 2 raises. And those that think that we're headed for recession. So we have this very divergent view about the economy, and that is causing a lot of volatility as we move between those different views.
Yeah, it's true. Wall Street thinks one thing. They're suspecting or predicting a sharp slowdown in the new year. And Main Street might think the opposite. Kevin Hassett was on after the bell yesterday, and he said, you know, Wall Street doesn't gauge all the momentum that we're seeing in the economy. Small businesses are not part of Wall Street, and they're doing great right now.
Yeah, if we look at the consumer, which is 2/3 of our economy, and just look at the holiday spending season, look at the fourth quarter, if we look at November retail sales, October revised higher, the holiday shopping season from November 1st through December 24th, best in 6 years.
Yeah, but consumer
Amazon having record
confidence was
sales.
down 2 months in a row. Sorry to interrupt you, David, but we do have that number that it fell 2 months in a row. What do you make of that?
Well, that's a lagging indicator, and a lot of that is a result of what's happened in the stock market over the past quarter. And so we'll see some of those, the soft data like that will soften as the wealth effect or lack thereof kicks in of what the stock market's been doing. But, you know, we're looking at 2 to 2.5% growth next year, not a recession. Unemployment, it's still near a 49-year low. And, you know, we just don't think a recession is right around the corner. We think the economy is still doing quite well. I think the biggest thing for the stock market is where do corporate earnings really come in? We think that we can still get 8 or 9% earnings growth in the fourth quarter, or in the throughout 2019. But there are those that think that earnings are going to fall off a cliff. If that's the case, we have trouble. If earnings, you know, we can't match the record earnings that we had in 2018. But if we get decent earnings in 2019, just 8 or 9%, we don't even need multiple expansion, we can do okay. The stocks can do okay through 2019.
David, if you go from, say, 20% right now in corporate earnings to about 8 or 9%, I think the estimate right now, consensus is around 7%, so 8 or 9 would be a little bit higher than that. That's not falling off a cliff, as you say, but that doesn't portend itself to the volatility that we've seen. Is this volatility really on different views of the economy and what's going to happen next year, or is it about the things the market can't control, like Brexit, like this trade war, and so many things that's going on with these capricious politicians we have around the globe?
Yeah, it is. You know, when we look abroad, when we look at Europe, whether it's yellow vests in France, whether it's Brexit, the problems in England, whether it's Italy arguing with the EU about their future, you know, Europe has a lot of problems, and we're avoiding Europe. We have this year for the last 3 quarters, and will be going into 2019 because of the problems there. We're staying with U.S. stocks. We're starting to look at emerging markets. But yeah, that's, you know, we do have a lot of anxiety and indigestion for the markets that's coming from D.C. recently. And certainly the China-U.S. trade issues are a concern, because that's where government action does affect real economies, affects the stock market. So how that all works itself out in the new year will definitely matter. But as we look further into the year, it'll be a function of when we get into the first quarter, what do those corporate earnings start to look like?
David, the Wall Street Journal is out with a story titled "The Investment That Cost Apple $9 billion in 2018," and it references the effect market prices have had on companies' decisions to buy back their stocks, specifically Apple. Buybacks have helped support the market. Do you think we're going to see companies then buying this dip?
We've seen a little bit of that. The funny thing about stock buybacks by corporations is they tend to buy high, and that's not because they don't know when to buy stocks. It's more a function of the reason or their ability to initiate those buybacks. It's typically when the economy is doing well, when the company is doing well, because they're buying that with free cash flow. So they tend to initiate more stock buybacks during good economic times when they have high revenue, high profits, high free cash flow. So they tend to be buying high, not buying low. There have been some companies step in with stock prices lower and initiate some stock buyback programs here late in the year. But, if we do see more of an economic slowdown next year, we could see that. This year, with the corporate tax reform and the strong economy, we had over $1 trillion, a new record, in stock buybacks in 2018.
Are you concerned at all about companies and the amount of cash that they're holding? And also, we saw the Steven Mnuchin, the now infamous call to the banks earlier this week, concerned about their ability to lend. Are you concerned about any of these things?
No. A lot of us were left scratching our heads why that letter was sent out, why those calls were made to the bank. There wasn't a concern about liquidity. We think that was a reason for some of the market volatility on Monday, on Christmas Eve, because that probably wasn't needed. And what we've seen, though, is maybe a steadier hand now. I think the more amicable tone of President Trump towards Jay Powell at the Fed.
Well, you think there'll be a face-to-face meeting between the president and Jay Powell? Because that's what's been reported as a possibility. Would that help the market sentiment right now?
I think it absolutely would, and they say it's going to happen. I hope it happens because, the fact that they're just meeting face-to-face and talking will be better than comments over Twitter and however else, because it's not doing the markets any good.
The theme of 2019 then is going to be talking, whether it's Trump and Powell or Trump and President Xi of China. Just talking will get these markets to go up, I suppose. David Kudla, thank you so much for joining us on this Friday.
Thank you.